Welcome to the Open Treasury Podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where Treasury professionals learn and share the information that matters most. And now your host, Jack Large.
I'm here with Craig Jeffery, Managing Partner, Strategic Treasurer, to review three important Treasury topics that we've covered in the last 2 weeks. The first one seemed quite innocuous, but the more I looked at it, it became more and more important. And it was two items linked, really: the impact of the move to AI and Accenture's suggestion of moving to multi-speed approach to business data and analytics. Let's look at the first one, the artificial intelligence market, which is predicted to reach $360 billion by 2028. Everybody's doing it, and the report reflected that. My question, though, is for you: how did you react, and how do you think corporate treasury is going to react in moving inevitably towards this greater and greater use of AI and machine learning?
Yeah, I think we've seen the attention paid to it on the corporate treasury side go from almost nothing to hitting the early stages of growth to more firms are thinking about it, and they're adopting it through their technology providers. So, in terms of what you were saying about the more you thought about it, the bigger this is, I think that's really, really the case. And your tie into the other part about this, hey, there's so much more data, there's more analytics. We see both of those tying together. How do you handle more data? Well, AI. And I know the article about AI I think it was heavily focused on things like fraud prevention as one of the examples of why they had to do it. But there's a huge number of other applications in finance that will bear watching and bear developing.
One that particularly struck me as important is that the regulators are getting into the use of AI and tracking organizations and the behavior of banks and corporates as well, in terms of, are they breaking the regulations? The other piece, which I loved, and it's one of my favorite people in the industry, David Birch at Hyperion, he was talking about banks are developing robos for individuals. So the AI robo would have an advocacy role, providing background information and translating things for the uninformed customer. I love that. If you think of it in corporate treasury terms, they get some really interesting concepts there.
So, Jack, some of our servers, we have tools that block suspicious behavior on the site that manage activity from an email perspective. And what we found out is some of the tools that people are using, some of these advanced tools to protect their employees from emailing or accessing different sites, we found that our two machines were fighting. Both were thinking the other's behavior was anomalous, and we had to get involved so the machines weren't blocking each other continually. So I think there's some unintended consequences, but you're exactly right. How you meet corporate treasury needs, how we protect organizations. It's a huge market, and there's a significant payoff for pursuing this.
And another interesting concept that was raised in the report is that AI is not just restricted to use cases that involve masses of data. It can be used in a more contextual way. In other words, if this has happened, that has happened, and then 4 or 5 things down the line. And then the 6th thing is the thing that it traps the fraud or sees the opportunity. Now, I'm looking forward to corporate treasury departments really getting involved there, because AI enables decision-making to be carried out in a much more detailed, quickly, and in an audited manner, which again is really important. The other aspect of this 2 items that we featured on automation was the use of Accenture promoted an idea which inevitably you can see consultancies doing this, where they are saying that you need a insight lab and data-led transformation. It isn't just that you get people to do things at the highest level or at the individual level. You need to integrate the two. And they're suggesting a new concept for me of these rapid insight labs. Did you see this having application inside Treasury?
I did and I didn't. I think the part that I really liked about this, some of Accenture's points is, there's typically two different approaches, top-down strategy and bottom-up. Top-down is, what do I need to learn and know? And then how do I drill down into the data and where is that data? And the other is I build up from the bottom up and I put my data into place and then I figure out where I go. The concept of something is in the middle, I think is really, really key, whether it's an organization that's different or it's a transformation organization, I think is really where I might have a bit of a disagreement. But the idea of, we need to make sure we're handling these massive quantities of information and data and leverage them like a weapon or a tool for risk management, for detecting patterns, doing analysis, seeing trends. There's massive levels of value that organizations can have from this. And they're definitely onto something here about, creating something that can address those I'll just call it future questions you don't know to ask yet. As you look at data, you get an insight, you want to ask the next level question, the next level question. I think what they're getting at here is it's multi-speed and it looks at data from both perspectives, from the micro level to the top-down level. And that I think is a real different mindset than a lot of organizations have had with how they manage data.
Yeah, and this is a classic example of the problem that cash flow forecasting has. They have to look at it from top down, but they also have to build it up from bottom up. And we're seeing more and more of that integration of the two approaches. This particular approach by Accenture is not new. It's just, although their list of 7 things that you need to do to introduce a rapid insights lab is an important focus. Worth a read. Certainly that was an interesting article. Now, moving on, the other area that obviously came up in the beginning of the pandemic when people suddenly realized, oh, blimey, we really don't know where we are. And it was the working capital insights that became the fundamental thing. Now, the report from Australia reviewing the progress in Australia in terms of how they're needing to shape their post-COVID agility and focus on working capital. That was important, I felt, because it shows the fundamental drivers behind Treasury. Fancy risk is fine, but the basic numbers of working capital are so important.
Yeah, Jack, the thing that struck me on this was the deterioration. That was the deterioration of, days working capital. It seems like in Australia, the number is growing.
It's down by 3.1 days in 2021. That is huge. That is big numbers in GDP terms.
Yeah, and the whole issue of the supply chain and the issues of delivery, we feel that in North America, as you probably heard, but it's happening globally. And so there's holding stock or inventory is becoming an issue. This is probably one of the most rapid shifts of working capital that I can remember in well over a decade when people were measuring this. I don't know if that's actually the case or just my memory.
That's my reflection as well. But the key thing was that the end of the report, the Reserve Bank of Australia warned that Australia's economic outlook remains uncertain and uneven, with the lengthening of the working capital cycles likely to make business less prepared to face the challenges that lie ahead. Obviously, that's central bank speak. Companies are in trouble and they're going to have to be very diligent to get out of it, which brings me to mention that we're doing a web chat with Cashforce later this week on what's the real drivers behind cash flow forecasting. And one of the three drivers is undoubtedly freeing up working capital across the whole organization. There is lots of pieces of working capital that are not being used or just lying around unused. Again, a salutary tale from Australia, and we move to the last item, which was insurers get the message about climate change and the impact of climate change is going to have on the risks of the companies that these companies are insuring. Now, BlackRock did a survey of many different firms. In fact, the survey represented 27 trillion in investable assets. So it's significant. Now they're saying the overwhelming majority of insurers view climate change as an investment risk. Wow, I'm glad they've caught up. But where do we react to this? Why is insurers taking so long to do this? Why is it only now? Have you any thoughts about how corporate treasury can react? What can corporate treasury do about this?
It's interesting, as you look through this particular article and what people are doing. I mean, finance people are a very practical bunch. And so when you think about the insurers making adjustments, whether it's due to the general term climate change, warming patterns, et cetera, there's insurers have risk factors. And when they see what happens if, weather patterns are changed, there's higher winds or there's different levels of weather, severe, however it's caused, they're a risk-oriented actuarial type science that says, okay, now we're factoring those in for what our losses could be. So that makes sense to me that those portions would follow through for that reason. Other ESG items can be driven from other reasons, but certainly risk managers look at risks that are actually occurring.
Interestingly, the head of De Vere Investment Group, Nigel Green, he had a press release last week on the need for standardization of the rules of monitoring greenwashing or green investment. And he was saying that it's so essential to get the right numbers so that everybody agrees with what's going on. This, I'm afraid, is going to take too long. It's really quite worrying in terms of how we're going to go forward. But it does show you what the corporate treasurer is conflicted by. These standards, these green environmental standards, which aren't agreed across the piece, aren't agreed by all insurers, aren't agreed by all regulators. So they're confused. And I had a meeting with corporate treasurers a couple of weeks ago, and all of them said they weren't getting clear investment priorities from their board and from their senior management. Again, very worrying.
I don't find it as worrying because when data comes in and people need to make changes for whatever reasons, there is a quick response and to adapt and change, as long as it's, when we think about insurance companies or other activities, we're pretty good at responding to the data that comes in. Some of the projections and models, a lot of the boards aren't going to respond to because, they're models and they have different assumptions. But as they see different changes, hey, this is more fuel efficient. This creates different types of risks in this area, whether it's with environmental or other areas. I think if we have nimble organizations, people can react fairly quickly. So I know that's a little different take, but I like if as long as we have organizations that can respond quickly, that tends to be a nice balance.
Well, we'll see. We'll see.
No hate mail, please, right?
Okay, so over the last 2 weeks, what would be your key takeaways?
Two things. One is not really highlighted in any particular article in CTMfile, but the general theme on some of these macroeconomic conditions. So inflation, a lot of the impacts of energy, that seems to be creating a pretty significant impact and concerns about pricing levels, the return of inflation and higher interest rates. That's one thing. I think we'll see more about that over the coming months. On CTMfile, in the broader news, and probably in our chats, Jack. The second one, I'm going to go back to the first article you brought up and agree with you about the AI and machine learning. I think that's a really big area for growth. It's an area that I think we've seen people adopt more rapidly than they expected to, and we're really early in the process, so that should accelerate. And then finally, what I'm looking forward to over the next month or so, or several months, is Treasury's understanding of platforms. And that was touched on lightly in some of the articles, but the idea of a platform versus a system is creeping into the treasurer's mindset. It's certainly in the technologist's mindset. I think there's a lot of implications there for banks, for corporate treasuries, really everyone in the space. I think that's both exciting, and we'll probably have to put a lot of ink to paper or digital codes to the CTMfile on that topic in the coming weeks. How about you, Jack? What are your key takeaways?
Yeah, that last point, I do agree with you. I think we're going to have to focus on this much more, and we've got various plans which you'll see in due course. My takeaway, unfortunately, is back to my worry of whether the world's taking climate change seriously enough. There isn't enough speed, in my opinion, and I agree with Nigel Green from Devere that we need these standards now, not in 2 years' time, now. And somehow we've got to get the central bankers and the governments to just agree them and force them on to companies. I just wish that goes well. Okay, so it's been an interesting 2 weeks in various ways. Thank you.
Thank you. And I know this is the week of Thanksgiving in the U.S. I know you don't celebrate it, but I'll say it anyway. Happy Thanksgiving.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.